little bit about African Alliance Asset Management. It's difficult to talk about asset management of African Alliance without talking about African Alliance as a group. And the group has started off in 1996 as from investment bankers who are based out of South Africa, who are looking to do something different and something more pioneering across the African continent. And the group started in 1996, and it's one of the largest Pan-African investment banking, privately owned investment banking groups across Africa. It started off in one country, Swaziland, and has continued to grow to over 14 countries in Africa, and has a strategy to continue to grow probably to about 20, possibly 25 countries across Africa. And why? It's because the African Alliance Group philosophy felt that this is the right time for the Africa to grow in terms of investment products, investment services at an internationally standard level. Why? Africa is growing. The continent has come out of historical issues. You can think about, maybe 30 years ago, 40 years ago, there were just wars, conflicts, a lot of political tensions across the African space. But that has since gone by. And of course, now there's a lot more conversation around infrastructure, looking for exploring new opportunities, commodities and the like, as well as international financial services and products that have since come in. So within that space, African Alliance as a group decided to actually explore. So within the group, African Alliance has 5 or 6 divisions. So there's the asset or the investment bank, which comprises of the brokerage, advisory, corporate finance, and asset management, where we belong. And then they have other businesses like they'll have an insurance business, an energy business, a property business, and a microfinance business as well within the group. But within the asset management financial services group, asset management is a very core part of the investment bank. And within asset management is in about 7, 8 African countries now. And within those countries, we are within the 8 countries. Kenya is the bridgehead, or is the head of the region, which actually takes care of the East Africa region. And that's where we sit, and that's where I sit, that looks after the asset management business within Kenya, Uganda, and Rwanda for this region. And what is the asset management business? It was actually started in 2001 in this region. We were the first to start unit trusts, if you know unit trusts and mutual funds. And African Alliance was very pioneering, and that's the philosophy of the African Alliance, to actually bring in international best practice, international products to the local African space, using the local professionals, using local investment professionals and financial and highly skilled professionals in this field. So that's when it started. And ever since, it's carved itself within that space around the unit trusts and expanded now into other sectors, which is institutional investors, international investors, NGOs, parastatals. We also do a lot of retirement funds and the pension industry as part of our product offering. So that's been really African Alliance as a group. And we're also now in Rwanda. We are also now pioneering the same products in Rwanda. And we're excited that that market now is maturing, able to provide investment offerings to clients. I mean, you know very well Africa, we've always been used to a savings account, which really pays nothing. So we are offering these sort of opportunities to these markets as they're starting to open up and starting to actually expand. So that's what we do. Group, we're slightly over $2.5 billion as in terms of assets under management so far. And that encompasses across the 8 countries across Africa. And in Kenya, slightly, we are talking about $500 million US dollars in terms of the assets under management within the Kenya region. And then, I mean, within the East Africa region. Within Kenya, we are slightly above $350 million. As investment bankers or people who actually invest in this market, and I'm talking now across the industry, the banking sector has been a very sort of critical area for investment funds to actually be a part of the destination. In other words, buying bank stocks. So the challenges has been around with the interest rate capping environment. What does that do to actually the valuations of these institutions? And are those valuations now giving the right sort of pricing? So the sector is actually going through a little bit of metamorphosis and change. So what we've seen is that consistently the banks that have been able to manage and become more efficient are the ones where most of the investment destinations are going to happen. So with interest rate capping, we're actually no longer seeing big bank, small bank. We're actually seeing efficient and not efficient banks. And that is really what's driving the valuation. So that has impacted quite greatly in terms of the view of where the actual pricing of the share prices will actually sit with the banking, within the banking sector, which has been a significant sector in terms of investment destinations. Other sectors like telecommunications, the likes of Safaricom's, or the other, say, manufacturing and distribution, the EABLs and Bamburis, those ones sectors are good, but banking sector was taking a bigger portion of the equity allocations within the asset management space, or even in the investment banking space. And that is really the biggest concern, how these institutions will be able to manage their balance sheets going forward in view of the interest rate caps. In addition, January 1, the IFRS 9, yes, which now is additional capital allocation for any of your products that are deemed to be riskier. So that is part and parcel of where we're looking at. So there's a huge review around the whole banking sector, and we think the more efficient banks that will come out will actually be able to deliver consistent performance. Some might fall in the wayside. I mean, they will not be able to survive in the present environment, because to be able to actually, banking is about, deposits and liability mobilization. So you would have to pay up if you are a smaller institution or a non-efficient institution for the services you're offering to the similar size institution who has also to pay up for the same sort of, where would you put your money? So most of the time you'd find deposit mobilization becoming a challenge, and now brings the issue around efficiency, cost management, the issues of non-performing loans, to say the least. How well are you able to manage that? And that will now drive the future of the banking sector. And we are seeing technology being a really big part of that. So those that are not prepared for that, this impact will not survive. Not even consolidation, not survive at all. Because if you're two sick institutions,
yeah, we can't.
What value? Exactly. I think they are very noble, because the Nairobi Stock Exchange would like to actually, as part of the Vision 2030 platforms, to be a to create Nairobi as a hub for financial destination across, to be the hub for the investor and financial services destination across Africa. And building Nairobi towards that hub. Part of that is be able to provide international products that are trading internationally, and be able to provide an opportunity for investors to actually have an opportunity to invest in some of these new products. The challenge has been a couple of things. One, being new products in this market, they take time to put together, take time to actually put the infrastructure together. They take time to actually even provide capacity building, so that some of our colleagues in this market are able to understand what these products are. They also require large capital flows to be able to actually make them work. So that has been the process. We've come a long way with the Nairobi Stock Exchange. We're engaging with them continuously around these products. And they're now almost getting to the level of now starting to test. And we will see them coming into the market slowly but surely. And like anything else, it will start small. We don't actually see a big uptake in the beginning. Why? Because they are limited to certain aspects around the derivatives space, and I believe they're doing, I think, the exchange derivative, and I think maybe on the interest rate side as well. But they're not doing beyond that. So there will be an opportunity, but it's a good start. And for us to become the international financial services hub, these are the kind of products we want to bring into this market to compete with the likes of Joburg Exchange, Egypt, and other markets. So we are in the beginning. So we are slowly crawling, but we'll continue slowly before we start walking. Yeah.
Where do you see African Alliance Asset Management in 5 years?
I think we'll see this business will continue to grow. We've consistently grown year on year to bring in an international best practice to the Africa space. We'll continue to provide new products, particularly to our niche markets, because we are a boutique investment bank. We're not an investment bank for everybody. Providing the level of products that will be required. Where we see opportunities in this market is around the infrastructure space. So within that space, we will see a lot more activity, and we think that is where African Alliance will have the value add, because from a group perspective, we've seen a lot of good work in that space around infrastructure. What do I mean? When government is looking for funding for expansion of roads, we want to participate. When we are looking at the railways expansion, we'd like to participate because we are long-term investors. So we want to be in that space going forward. We want to continue to deliver professional services. We want to be a very, very strong brand in that space and be able to be maybe the number one or two player in this market around investment products and as well as market share. The industry growth has been very consistent. If you look at the RBA reports of the last 10 years, the pension industry is growing on average at about between 15 and 20% every year. We're now close to about $1 trillion in terms of the size of the pension fund industry, in terms of assets. $1 trillion is about, what, $10 billion? It's a big market. And that has been a great testament in terms of the industry growing and, of course, the infrastructure around the industry growing. We are seeing that continue to grow. There are challenges, of course. Why? Because nobody wants to work in any company now for 30 years. The professionals levels are more or less that sort of space structure has actually is more of a I don't call it dying, but it doesn't seem like it has a larger future. But you also still need to have retirement as part of anybody's view. So how else would you be able to provide a safe haven for when you retire? Just like yourself in your sort of business, nobody really thinks about that part of it, but you need to have that space continuing. It's a retirement sort of a safe haven as well as saving product. So that we'll see us continuing. Will it be in the same structure? I believe not. So there'll be products that will be coming up for individuals, like individual pension plans. There are chama groups that are now deciding to get together to start their own sort of saving and retirement sort of offerings. So we'll see a little bit of dynamic changing in that space. Technology will also come into play, where we are hoping at one point in time the mobile level transactions will be able to also deliver a space for retirement opportunity for people to actually retire using the mobiles as part of their technology, to be able to provide a funding base for them. So we are seeing that as the upcoming sort of an area that will be the newer thinking. But the traditional pension schemes, I think, because of the nature of the employment environment, the work, the sort of nature of jobs in today's age, everybody's self-employed. There are really fewer and fewer companies hiring people for a long period of time. We are seeing government looking at downsizing the size of government, particularly in this parastatal space, some of them actually being taken into the public by privatization. So we are actually going to see changing dynamics in that space. However, the principle around savings and saving for retirement has to maintain and has to continue.